I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's show is Yann Robard, founder of Dawson Partners, a leading global alternative asset manager overseeing $20 billion that provides innovative, structured solutions to the private markets. Formed initially as Whitehorse Liquidity Partners and rebranded as Dawson, both names are inspired by Yann's 1,000-kilometer bicycle journey in the Canadian Arctic that led to his becoming a trailblazer in the market. Our conversation covers Yann's entrepreneurial path, including 14 years in the formative stages of Canadian Pension CPPIB. We discuss the success of the private equity industry, valuations, liquidity, the necessity of scale, and creating solutions that balance the needs of GPs and LPs. We turn to the process and culture at Dawson and the exciting future of the secondaries market. Before we get going, here's a shout out to all the investor relations and business development professionals. Your role is one of the toughest in the industry because unlike in many other industries, the functions of marketing, sales, and customer relations rarely drive purchase decisions in investing. It's often hard to know how to move the ball forward when allocators are busy and opaque about their process. So we decided to create a Capital Allocators University experience just for you. On December 3rd and 4th in New York City, I'll be joined by your peer and superstar Rahul Mudgal, branding expert Jen Prosek, founder of Prosek Partners, conference wizard Ron Biscardi, founder of iConnections, and investment leaders Sarah Samuels from NEPC, Dave Moorhead from Baylor, and Shannon O'Leary from St. Paul and Minnesota Foundation to help you learn best practices for understanding allocators, developing relationships with investors, and building a brand through workshops and peer discussions. You can learn more and sign up to join us at capitalallocators.com/university. Thanks so much for spreading the word about our newest Capital Allocators University course for investor relations and business development professionals. Please enjoy my conversation with Yann Robard. Yann, great to see you.
Hello, Ted.
Why don't you take me all the way back to your upbringing?
Well, my upbringing is probably a little bit different than most finance people's in the fact that I grew up in a family that was very left-leaning, to say the least. And so as I was growing up, the narrative is that the 1% were not necessarily the best type of people. And through all of that, somehow or another, I stumbled into finance, and here I am 48 years later.
So what was that like with the 1% not being the best people, whatever that meant in your family?
Well, the question was whether or not you could be successful and be a good person. And so it was a narrative that was less about the money and more about taking care of others.
So how'd you get from A to B?
Interestingly enough, it all started on a co-op term that I had where I ended up in investment banking. I didn't know what investment banking was. I showed up the first day with an earring in my ear. I had khaki pants on and a sailor jacket, which is basically a suit jacket with gold buttons. The individual that I first saw brought me into the office and they basically said, "You're going to have to take that earring off to work in investment banking." And I said, "Really?" Because I've had that for a couple of years and this is late 90s. So this was a very different era. He said, "Yeah, I don't know what to tell you. You got to take that earring off to work in investment banking." So I took the earring off. 2-3 days later, brings me back into the office and he's like, "Just so you know, you're wearing khakis and a sailor jacket with gold buttons. I think you think you're wearing a suit, but you're not wearing a suit and everybody's noticing. So you should go buy yourself a suit." And I was like, "I don't have the money to buy a suit." And he's like, "Here's $200. Go buy yourself a suit and come back to the office." So off I went. And that was my investment banking opportunity, which was a very eye-opening experience.
So outside of your clothing style, what did you learn in those early years?
I learned how to work hard. I learned a lot about finance. Finance was a bit mystical for me because I hadn't grown up in a world where finance was really discussed. So it was a different world for me that I was navigating, and I was growing quite significantly during that period of time, learning lots, working hard.
Where'd you go from there?
Somehow or another, I got a full-time offer to go back to this investment banking firm. And in my third year of university, I went to Sweden for 6 months. I met 3 Mexicans there. I went to Mexico during spring break of my 4th year, and I realized, hey, there's an opportunity here to import Mexican furniture from Guadalajara to Toronto. And I came back and I thought that was a much better idea than taking the investment banking offer. So when the person called and said, hey, I got good news, he worked hard to get the sailor jacket guy a full-time offer. It was not obvious at the end of the day. But he came back and he's like, I've got great news. I've got an offer for you. And I said, I'm not going to take it. And he's like, well, what did I lose out to? Is it another firm? And I was like, no, I'm going to start a Mexican furniture store. And he's like, sorry, we lost the sailor jacket guy to a Mexican furniture store. I did that for about 2 to 3 years. And, you know, in a funny kind of way, it was both the best and the worst thing I ever did, mostly the best thing. I really learned how to take idea in your head and make it happen and how to make decisions at a young age. Nobody was telling you what to do. You really didn't have any bosses. You were the boss. So you just had to make the best decision with available information. And that's something I've taken through my whole career with that.
What's your favorite example of that in the Mexican furniture store?
Oh boy, there's so many. I mean, we're going to have to go through and have a beer over this one at some point in time. We essentially had wine racks that was going in the wrong direction because we literally had no idea what furniture was or how to go about doing it. So we were learning lots. And I did this with a partner of mine, and we were 22 and 24, and lots of big lessons learned, including resilience. I think that's probably the one that I learned the most, is how to just lean into yourself and create conviction around an idea that you had, and that with grit and patience and passion and persistence, humans can do a lot more than they think they can.
What happened after those couple of years?
So it was now 2001, and the tech bubble was bursting, and decided that probably not the best thing to do was be in the Mexican furniture store, despite all the great experiences. So somehow I got a job at JP Morgan. So I got back into investment banking. And 9 months later, I decided to leave because I got a call from the Canada Pension Plan Investment Board in December 2001, asking whether I wanted to be part of a team that was building a private equity portfolio. I didn't know what private equity was at that point in time, but it sounded great. So I chose to leave JP Morgan. And people looked at me and they were like, your ability to make career decision is zero. You chose a Mexican furniture store over investment banking. You got back into investment banking, and now you're leaving to what at that point in time was the government, essentially. But I thought to myself, look, whether or not this works, I'm going to learn a lot. They had a big vision in terms of what they were going to do with their private equity program. So I leaned in.
Take me through your path at CPPIB.
When I joined in 2001, there was 24 people. I left, there was 1,200. We went from 7 billion to 285 billion from 2001 to 2015. It was an entrepreneurial adventure of watching an institution come to be. And what they did was they fed my entrepreneurial spirit by allowing me to go build businesses along the way. So at the beginning, I started with building a funds business. Then I was involved in opening the London office. And then in 2007, they gave me the mandate to build the secondaries program. So we went from doing funds and co-investments to essentially building a direct team. And we built a team of 15 people that went and built a direct program in secondaries out in the marketplace. So I guess the last chapter, they gave me the ability to launch a co-investment program as well. So 4 different chapters along the way. And it was an entrepreneurial experience with institutional support.
If you look at that window of time and those 4 businesses in particular, each one was, you could say, relatively early compared to the scale that they're all deploying capital today. What was it like to be at the forefront of a bunch of these different subsectors within private equity?
Fascinating. I think the one thing about all of this is that I've been in this industry for a really long period of time. So I've developed a good understanding of the ecosystem and a deep understanding of private equity during that period of time. But what it did do was enable me to give me the skills to really understand how to, again, take an idea and make it happen. So at the beginning, it was funds, then it's opening up London, then it was the secondaries. And so always kind of leaning back into that entrepreneurial flair to really kind of build businesses from scratch and then enable them to scale successfully.
When you think about each of those experiences, what are the commonalities that you had to go through in taking the idea and turning it into a business?
You just needed to have conviction in your ideas. Like you spot an opportunity and you have to really go after it. And that takes passion, persistence, and patience, something I learned during the Mexican furniture store days. And that has been essentially my whole career path, is just leaning into, not with arrogance, but with confidence and conviction around an idea. And when people tell you that it's not going to happen, not listen to them. Just go after the idea. If you believe in it authentically and genuinely, individuals and humans are so much more capable than they think they are. And I think there's a lot of self-limiting beliefs out there. And it is a lot of the time chatter around other people that are telling you it's not going to happen when it can.
How much of that chatter in the seat you were in was internal? And you think about a pension fund, you don't always think of these types of entrepreneurial endeavors.
Well, it was really interesting because that period of time, certainly in that era, CPP was building, and it was very thoughtful in the way that it went about allowing them to go into different products. And they were an innovator in that market. And I got lucky. In hindsight, everything I've done in my career has always been about intellectual compensation over financial compensation. And I was lucky to be in the right seat at the right time with that organization that was enabling us to go out there and pursue ideas during a period of time where that firm was growing and scaling really large and trying to find ways and unique ways to deploy capital where they could generate good risk-adjusted returns. Now, did I wish at the time when I was going through that it would go quicker than it did? Absolutely. I was a young whippersnapper that really was impatient at times. But in hindsight, looking back, it was just this incredible experience. And actually those moments when they held me back a little bit and I thought I could do more, it was actually keeping me on the playing field so that I could really recognize patterns and behaviors and really understand the art and the craft of this so that it made me a better person as I grew up. It went from like being a player to player coach to coach. But you need to be on the field for a while to be able to be a good player coach and coach. So I'm very fortunate for my mentors.
So if you look at that 14-year window, 01 to 15, first funds investing, then international in London, secondaries, co-invest, all early. What were some of the signposts that you saw that said they gave you conviction in those particular opportunities?
Yeah, the interesting thing about these markets is that you need to be half a step ahead of the market, but you can't be a full step ahead of the market. It's really interesting. Markets need evolutions, not revolutions. So one of the things that I learned while I was at CPPIB is there's so many times where it can be a good idea, but if the market's not ready for it, you can bang the head against the wall unless you pivot and adapt to make the strategy consistent with what the market is ready for. And I think that was a huge lesson for me along the way in all of the different businesses out there in terms of being able to really, like, people bang their heads against the wall. And then if you look right, there's a door right there. Just go through the door. One of the things at Dawson that I'm the most proud of is just how we've pivoted, how we've adapted, how we listen to the market at the end of the day and be able to continuously innovate based off the feedback we're getting from the market to be able to provide interesting solutions to both our counterparties and our investors. This has been a journey of innovation. I mean, sometimes we call ourselves the Google of private equity because we're always coming up with new ideas, new financial products, new financial technologies at the end of the day. But innovation needs to be done in a way where the market is ready.
How did you decide that you were ready to leave CPPIB and start Dawson?
It had been 14 years. I had had a great run. I was turning 40. I was getting, I think, at a point in time where I was increasingly less inspired, not because of the organizations, because they always have a special place in my heart. I just needed change. And so it took 2 to 3 years for me to kind of just go through that gestation period, because you can have good days and bad. And then you go through a period of time like, okay, that 3 months wasn't as fun as the last 3 months. But once you start getting to a point where you're just like, it's been 6 to 9 months and I'm feeling less inspired. And then you have to take a year or a year and a half to actually build the conviction to go out and do it. And where it really came to be was this infamous bike ride that I took from Whitehorse, Yukon to Fairbanks, Alaska. And the midpoint of the journey was Dawson. And so on this infamous bike ride, it's about 1,000 miles. I was sleeping on the side of the road. The Arctic has a special place in my heart. And essentially, that's where the idea came to be. And on this bike ride, you can imagine I had a lot of time to think, maybe a bit too much time to think. But I was thinking about, look, okay, I actually love what I do. I just need change. And is there a market opportunity out there where I can really kind of lean into it and provide a new tool in the tool set for private equity investors? And as I thought about it, I thought about maybe we can be somewhere between the debt and the equity and provide preferred equity or structured equity for private equity investors. Can we enable them to accelerate liquidity on their private equity portfolios, but keep the upside and the flexibility? Can we give more tools for people to be more active in the way that they manage their private equity programs? And lo and behold, we went from this bike ride where I came back and I went to my boss, and my boss said, "You're having a midlife crisis. Go think about it." I came back a second time. He's like, "You haven't thought about this, this, and this." I came back a third time. I told him, "Look, this is not about you. This is about me. I need to go do this." So it took me 3 attempts. It was like Hotel California. I could check in, but I could never check out. But eventually I got to a point where it was go time. And that was June of 2015 on my birthday.
I want to break down a couple of pieces of that. The first is this 1,000-mile bike ride. So you're working, you just randomly hop on a bike for 1,000 miles. This is something that you've done in different iterations repeatedly. I'd love to hear about that part of your journey.
Yeah, so nature soothes my soul. I have spent a lot of time in nature to just kind of recharge, and some of my best ideas have always been in nature. So I've have a history of spending time, and I've gone through different chapters. I had a hiking chapter, then I had a biking chapter. I'm in my canoeing chapter, but it always, I think in my 20s of exploring the world, but probably in my mid 30s, I was like, well, wait a second, time. There's a lot to see and do in Canada. And I started going to the Arctic, which is the territories in Canada, and started spending time doing week-long canoes. This particular trip was 2.5 weeks of biking, just to really kind of clear my head. And particularly some of the best ideas that I've gotten for Dawson has always happened in these trips, where on day 1, 2, and 3, your brain rests. Not much goes on in there. On day 4, it's now rested, and it's just like there's such clarity of thought. And you're like, oh, well, that's what I have to do. And so that's what I use nature for, over and above just being out there. And I'm a bit of a social introvert. So I need time on my own to recharge. And that's what nature and that's what the Arctic actually provides me, all these great ideas.
So in these trips, how do you think about balancing planning and serendipity and also being out in nature with safety?
From my perspective, you got to be safe, and you figure out ways to go about being safe. The people that you bring with you, obviously lots of safety. I don't know that you balance the serendipitous part of it. Like, I think for me, it has become like this incredible release where my life is chaotic at times. And these points in times are so special where you can put your phone down for a while and just really take care of yourself, take care of your mind, have kind of a rest and recharge. And safety comes with just preparation at the end of the day and knowing what you're doing and knowing your limits.
So in that context, you had this middle road idea, debt and equity. And as you said earlier, anytime you're trying to innovate, you have to pair it with where the market is. So I'd love to get your perspective on, after spending those 14 years in private equity, how you thought about the private equity market in the context of what you were looking to do at Dawson.
So deep appreciation for private equity, and I will put on the table that I am biased on private equity, having watched it over the last 25 years. I think that I am a big believer that private equity does outperform public markets. And we have spent a lot of time trying to look at the data in so many different ways. And over the long term, or at least any kind of 5, 10, 15, 20 years, I don't see a time period where private equity hasn't outperformed public markets at the end of the day. And so what I recognize through that experience is that this is a market that I want to lean into. This is a market that I really believe. And I think that from my perspective, spending a lot of time understanding why is it that private equity has outperformed public markets.
And what are those key things?
Like, the answer for me is that I do believe public markets has its set of issues. 70% of public markets trade automatically, ETFs, passive. So you got 30% of the market that's actually active. Of that 30%, what percentage are actually active? And by the way, when you are a public company, those people that are stewarding that company are usually stewarding towards quarterly earnings. Is that the best way of managing a company to long-term value, by making them focus on quarterly earnings versus the long-term success of this business? So what private equity has brought is this model where there is probably more alignment with the managers, with the shareholders, with the ultimate beneficiaries of it, because usually more often than not, the people investing in private equities are pension plans, insurance companies, and if they outperform, the net beneficiary are the underlying individuals. But with that alignment and with that patient capital, what private equity can do is actually focus on providing the time necessary to build the business over the long term. And sometimes it takes investments in the business where it might impact quarterly earnings to do best for the company over time. And I'm not saying that private equity doesn't have its flaws. It goes through cycles as well. People will do things from time to time. But generally speaking, on average and over the long term, private equity has done better than public markets. We call this the alternative investments. I'm not sure it's so alternative. And if you think about how many public companies have stopped being public companies over the last 10 years, about half as many, you got to ask yourself, the capital is flowing to private equity for reasons. Companies are choosing not to be public for a reason. I find it really interesting because there's the age-old debate as to whether private equity has outperformed public markets. I think the answer for me is clear. Yes, it has.
So you've had this environment with rates dropping from sky high in the 80s to until recently next to nothing. And that has that benefit of valuations rising. How do you respond to that critique of, well, private equity smooths their marks are too high, there's not much happening in deal volume because of that?
So I think there's one narrative that I hear a lot in private equity that I struggle with, and that is that private equity valuations are opaque, they're irrational, and particularly in times when public markets decline and private equity doesn't follow. So we spent a lot of time on this. What we did was we went back to 2005 to 2022, and we looked at over 1,000 companies, and we asked ourselves, when a private equity company exits, what does it exit at relative to what it was carried at 2 quarters prior? And the answer is it pops 28%. So there is a 28% gain at exit, which suggests that private equity is undervalued, not overvalued. So people have said, okay, that's on average for 15 years. But what does it mean like year over year? Because there's got to be good years and bad years. And actually, if you disaggregate it by vintage year, what you're seeing is that it's incredibly consistent between 20 and 30% from 2010 to 2022. Then people are like, yeah, but maybe the winners get a big pop, but the laggards, they must be sold at a discount or less in value. And actually, we disaggregated it. And yes, there is a success bias for companies that have been held less than particularly 2 years, but less than 4 years, because GPs haven't been able to value the company at the pace in which the value was increasing. Otherwise, LPs and maybe the market would be skeptical. But even the laggards, the one that's been held for 8 years or more, are popping at anywhere between high single digits to double digits. So the winners and the laggards actually exit at pops to their valuation. So when we look at that, private equity is actually undervalued, not overvalued based off that information. And you can find examples for sure where there's a company that may have been overvalued and will be sold at a discount, but on average, during that period of time, it has. The other thing that we looked at was, what are private equity multiples versus public market multiples? And what you see, and certainly over this crisis or this time period since 2021, public markets have gone from 13.5 times to 21.5 times LTM EBITDA. Private equity has stayed consistently between 13.5 to 14.5 times. So you ask me which one is rational. Is it the public markets that are moving from 13.5 to 21.5 times? Or is it private equity that has stayed at a band of 13.5 to 14.5 times? On exit, M&A on average is 25% and IPOs are 42% pops, which would suggest that public markets pays more for assets on the exits than M&A does, corporates. So it's another tidbit around whether public markets may be paying up for assets that are exiting from private equity versus a corporate world. We believe that, we've got a paper out on this, that private equity is a rational one.
So what's interesting is if the data is showing that private equity exits to the public markets have a pop, we also know that on the entry, there's a pop from the public markets and the take private. What happens in the middle?
It depends on what time period that you're talking about. I would say from a good part of the time and from over the last 20 years, what has happened is that private equity has bought well, has then added value during their hold period, and then essentially been able to sell at a better multiple because the business was in better condition, maybe because the owners of the assets weren't focused on quarterly earnings, but they were focused more on the 3 to 5 year and how to make that company better. So on exit, they got a better relative multiple than they did at entry. All of that is going to be debatable. You're going to find examples where that's not the case, but generally speaking, on average, if you got a better governance model where private equity can add operational value to these underlying companies, where there's more alignment between the management team, the shareholders, and the underlying beneficiaries, then what you have is you have a situation where businesses can get better on exit. And if they're better on exit, they might get a better multiple.
So if we tie this back into your founding of Dawson, the other piece that comes up in private equity is just illiquidity and whether the reason you're getting higher returns is you're getting paid an illiquidity premium. How did you think about that dynamic in the context of what you wanted to do at Dawson?
Look, I mean, I think from my perspective, so basically, if you ask me, well, what's the problem with private equity? Because I've said, okay, better returns, okay, better governance model. The age-old question in private equity is illiquidity, and that's where the secondary market comes in to help and enable liquidity to an otherwise illiquid asset class. And what it actually does is that it kind of enables the industry and the GPs and the LPs to have what they need. On the left side, you have GPs that need patient capital. They need 3 to 5 years to make sure that the company goes through the evolution it needs to actually add the value that it needs. On the right side, you've got LPs that have built their private equity portfolios in different times, in different markets, and has reacted to the markets in different ways. The secondary market sits between the two and essentially provides both and doesn't disrupt the ecosystem. The GPs get that patient capital. The LPs get to tactically reallocate their portfolios when they need. And when you really think about it, what's the secondary role? It's starting to sound like a public market. When you start selling a share of Google or Walmart at the end of the day, that's a secondary. And so this is what the secondary market has been doing slowly. It seems like exponential growth, but the secondary market has gone to $135 billion at its biggest year in 2021, and that represents 1% of private capital. So if you think about it, imagine a world where a public market investor would buy into the public markets and do nothing with it for 10 years. You would say that that's probably fiduciarily irresponsible. Well, that's what's happening in private equity. People commit to funds and they hold. And they don't tactically reallocate in good times and bad. The secondary market isn't there just in bad times. In 21, it was private equity done too well. They were overallocated for the right reasons. Should you tactically reallocate at that point in time? So that's what's happening. There's a shift in the sophistication that's happening in private equity, which keeps the model intact, which is what has made private equity, in my mind, special, given that patient capital so people can do the right things to the businesses and give the LPs what they need, which is a way of being able to essentially manage in a more sophisticated way their private equity portfolio.
So when you had that vision of being in between, how did you go about attacking it as a business?
On the bike ride, it was, if you want to generate liquidity on your private equity portfolio, you really have two options. You can either leverage it up, which in this day and age, you could get 25 to 35% LTV. Maybe before all of this, you could get 35 to 45%. Or you could go and sell. And if you go and sell, you're probably selling it in those days, 90 to par. In today's environment, probably more like 85 to 95, give or take. And so the concept was, can we sit in the middle and provide LPs with the opportunity to accelerate liquidity on their private equity portfolios and keep the upside? What we do is that we give 60 to 70% of the value of the portfolio. We'll take 100% of the cash flows from that portfolio until we get to Let's call it a minimum return of a multiple 1.3, 1.4, or 8 to 10%, and then we'll split cash flows, 80% to you and 20% to us. So we're not here to replace debt. We're not here to replace selling. We're here to give another tool in the tool set. But if you lever, you encumber your assets. If you sell, you crystallize a loss, you forego future proceeds, you time the market. With us, what you can do is you can accelerate liquidity on your private equity portfolio. You don't have to time the market. You don't have to crystallize a loss, and you have exposure to the future upside. That we see as a win-win, because actually when we outperform, that's a good thing for us and our counterparty. If they would have sold, then they would have left that upside to the buyer. With us, we can win together.
How did you go about finding the opportunities to provide that capital?
Oh, we did 2,400 meetings in 24 months when we first started. We just pounded the pavement. We just went out there. We talked about it. Like going back to passion, patience, and persistence. Like we had a lot of conviction in what we're doing because we just thought there's a place in the market for this. We just had a lot of conviction and we started talking to the market. The concept of what we were talking about, pivoting and adapting. We had to hear what the market was ready for. And we had to essentially take that, pivot, adapt, and then create structures where the market was ready for it. We probably came out and we were one step ahead too far of the market, and we just kind of slowly but surely took feedback and got to a point where we're 175 people. I mean, I'm pinching myself. This is way beyond my wildest expectations. I'm so grateful of everything that we've been able to achieve, and it's just been an incredible ride, and we're just beginning. That's the thing, is I look at it and I'm like, wow, we've stumbled upon something that is limitless. If you think about a $15 trillion private capital market that's going to grow to $30 trillion by 2030, our opportunities to inject liquidity into that market.
How do you think about scaling alongside of that industry growth?
I am a big believer in scale. I say scale matters. Big is beautiful. Growth is good. We, over time, have become bigger, better, faster, stronger. We've become more resourced, more informed, more sophisticated. We have been able to invest in our team. We've been able to invest in our technology. In the whole journey of this, what we have been able to do is show up in the market with a product in which we can execute with speed, with scale, and with certainty, all because of scale. It's interesting in the secondary market because as big as it's gotten, there's actually not that many players that can show up with $1 billion check to provide liquidity to a counterparty, certainly in speed and scale. So we're sitting there saying that's our opportunity. We say that we are unapologetic about our growth. We think that at the end of the day, growth is an important way that we differentiate ourselves in the market. And as I said, we're just getting started. And growth and scale allows us and positions us to come through for our investors. And that's ultimately what it comes down to, is being able to differentiate yourself in the market and being able to move at that speed and scale. But it's not the only thing. We say scale matters because actually what's really interesting and what I've learned along the way is that a growing firm allows you to attract really interesting talent. Because the problem is that if you're a firm that is stagnant, what happens is that you have glass ceilings. There's not as many opportunities. I grew up at CPP going from 24 to 1,200. The world was my oyster. That's the opportunity. We're growing, and that enables us to really attract some incredible talent, entrepreneurial, hungry but humble, in it together, stronger together. That's our mantra. We approach this in a way where we say, when you give, you get. When you do, good things happen. And we're not rip your face off people. We are, how do we create the win-win-win in everything that we do? How do we create partnership? Call it the Canadian way of doing business. But at the end of the day, it's not just what we do, it's how we do it that gives us great pride. We understand that without investors, there would be no Dawson. We understand that at the end of the day, we should be so thankful, so grateful for the confidence and conviction that our investors provide us and trust us with our capital. And that's what drives us every day. I always picked intellectual compensation over financial compensation. And that's the mantra that we have at Dawson. We love what we do. We're really passionate about what we do. And so the types of people we attract just are so intellectually curious and intellectually stimulated. They're young. They're hungry. I am so proud of the team that we've been able to bring. That's what gives me the warm and fuzzies when I see the team getting empowered, enabled. I could talk about this for hours. I'm not doing this for the money. What am I doing this for? And the word that I always use, which is overused, is impact. But impact can be on the employees. How do you enable and empower them? And if you can give them limitless opportunities within the organization and they say, hey, that's really interesting. Why don't I go spend some time over there? Go for it. We think about impact on our investors, because if we can actually differentiate ourselves in the market with speed and certainty, then we can come through for them. We think about impact on communities, because 1% of our revenues goes back to charity, and that's something that's near and dear to my heart. And if you talk to me about like, why am I doing all of this? This is really about scale enables us to give back more. And the other thing that we have talked about is impact on ourselves. I don't know what I'm doing. I've never done this before. And so I'm learning and I'm growing. And the reality at the end of the day is you need to be so humble in this journey. You need to be so grateful. I pinch myself every day that I'm in the seat that I'm in. And I got to tell you, I'm so lucky. And so you got to recognize that as scale, as success comes, how do you stay grounded? How do you stay grateful? How do you realize and recognize how lucky you are to be in the seat that you're in? And yet, we're just getting started. The vision is so clear for me in terms of what we can do with this. And if we approach it with the right mindset, if we approach it with when you give, you get, when you do good things happen, if you can come through for your investors, and we're not perfect, we're going to make mistakes along the way. But if you're not making mistakes, you're not learning. If you can't be humble enough to appreciate the mistakes that you've made and be honest with yourself and honest with others as to what did you get right, what did you get wrong, and what can we learn from that? If you get to a point where you really believe that you are flawless, then like, wow, you're heading in the wrong direction. I am a work in progress. And I'm always constantly trying to surround myself with people that are better than me, that have done this before, and just open and curious as to the feedback they give me, because I'm growing.
How do you maintain that culture as you grow?
That's my passion. How do we make sure that we keep that? At Dawson, our performance reviews are a combination of the what and the how. If you don't have both, you cannot succeed at Dawson. We measure out of 5. The what is 1, 2, 3. The how is 0, 1, 2. So if you're great at what you do, 3, and you're culturally consistent, 1, that's a 4, you move forward. If you are a culture carrier and you're good at what you do, that's a 4, you move forward. But if you're great at what you do, 3, but you're culturally inconsistent, that's a 3, you're not moving forward. If you're culturally carrier, but you're not good at what you do, that's a 3, you're not moving forward. It's that simple. So we are always focused as we bring people in, and we have so much that we do to really enable and empower employees to just allow them to grow. But it always comes down to the how as much as the what.
How have you organized your team to cover what's become an increasingly large industry?
We got 6 pillars at Dawson: strategic management, capital management, asset management, portfolio management, operations management, firm management. New products and partnership, strategic, capital raising, capital, asset deploy, portfolio manage the portfolio, firm management, service our clients, and then operations. And then within the asset management, we have folks that are in sub-teams, GP coverage, that merely are the financial sponsors, but also focusing on both primary co-investments and then also the deal-doing folks on the secondary side. I spend a disproportionate amount of my time thinking about organizational structure and making sure that we align the organization to how we do things, and making sure we have 2 offsites a year, one in January, one in June. We set KPIs in January. We keep ourselves accountable in June. And it's so important to bring the firm together, not just for informal bonds and being able to build relationships so that you essentially allow people to get to know each other, and that breaks down silos, but also to just really keep the organization focused in terms of what are the strategic initiatives, what are we trying to achieve this year, what are our priorities. The trick is to simplify complexity and have a clear vision so that people walk away from these sessions knowing, the top 3 to 5 things that we need to do for this half of the year or for the full year is this. So we spend a lot of time on that.
How do you go about making your investment decisions?
We have 2 pipeline meetings a week. We have Investment committee is available on Monday, Wednesday, Friday. We want to move nimbly. We want to move quickly. But it's actually pretty easy to parcel out our pipeline, because when you know what you want, the deal comes through the transcript and you're just like, pass, go. From an investment committee perspective, look, I think the reality is that it's an open room. Everybody can talk in the room. Everybody's invited to come in. And so we think that that's a way to kind of teach the young folks the nuances of how people cut to the decisions and how to go from an idea concept to a decision, and what are the questions and answers in order to get there. And it just feeds, I think, from our perspective, that culture of being better investors.
I'd love to hear some of the examples of what these transactions in between debt and equity look like.
Everything we do, we focus on the win-win-win. When we win, our counterparty wins. All our focus is how do we provide customized, bespoke solutions where we sit down and we really listen to what are the counterparty looking to achieve, and how can we essentially enable them to achieve that in an innovative way with a customized solution. Drawing on the 25 plus years of experience in private equity and understanding institutional objectives as they try and manage a private equity portfolio, to allow yourself to be open-minded enough to be able to really listen. What are they trying to achieve? This is not just a transaction. This is not just buy-sell. We're thinking about new financial technology, new financial products. In that LP financing example that I gave, that we're sit between the debt and the equity, and we're providing them an opportunity to accelerate liquidity on their private equity portfolio. Many times people have built these private equity portfolios over the last 3 to 4 years. They're sitting there saying, I love this portfolio. Don't make me sell now. And so they're sitting there as a team who's built that portfolio saying, I understand we're over allocated. It's a temporary phenomenon. And can we find a way that allows us to tactically reallocate, but keep the upside? And in the process of doing that, it's not just keeping the upside. They keep the relationships. They keep the co-investment flow. They keep their advisory board if they want. So there's a lot of different ways that you can talk to LPs, but the first conversation you have to do is, what are you looking to solve for? It's not us with a cookie cutter, here's our product, do you want to do this deal? It's like, let's listen. Oh, okay. Let us come back to you in a couple days. And by the way, nimbleness. We come back so quickly, thoughtfully. That's how we're trying to differentiate ourselves in this market.
How do you think about the portfolio that you put together for your LPs?
Diversification. So in the objective of generating resilient returns, muted volatility, consistent cash flows, first port of call is diversity. Diversity by asset, by sector, by geography, by vintage, by duration, by GP. Then the second port of call is quality. We're really looking to deal with quality GPs that have had experience through cycles. It generally puts us towards the larger end of the market. We can have a debate as to whether or not they generate the best returns. I would suggest that they have a good opportunity to do that. Either way, they're very consistent in the way that they generate their returns. And if you think about what we're trying to do around consistent returns, that's our focus. Diversify portfolios so that we can provide that consistency with muted volatility. And then the last part is our structure. So what we do is, you kind of heard, we essentially give 60 to 70% of the value of the portfolio, taking 100% of cash flows. So we're 1.5 times asset coverage day one. From our perspective, we've got the combination of diversity, high quality, structure, and the combination of those three things provides us what we hope is portfolio construction. Then we have a whole team called portfolio construction that is looking at our funds as they're getting invested, and they're saying, okay, well, we have a bit too much exposure here or too much of that sector exposure. So it's a real-time discussion between the total portfolio management team and the asset management team that deploys capital. And they're talking to each other saying, hey, the next deal, we would like it to look a little bit more like this. You need to know what you're looking for before it comes to market. We've seen $670 billion go through our shop. We've done $22 billion of that. So the trick in culling that portfolio is being able to see these portfolios and be like, that's the one we want. And that's how you dedicate resources effectively and efficiently around that, is being able to know what you're looking for. And when you see it, pounce.
What are some of the characteristics of what would cause you and your team to want to pounce on a deal?
I think we're always looking at multiple of carrying value, leverage levels, operating momentum, quality of the GPs. We proactively price 75 funds a quarter. We know what we're looking for. We know the average valuations, leverage levels, and we have a view as to the direction of these underlying funds and underlying portfolios. That then gets boiled into a quarterly investment theme that's saying, generally speaking, portfolio construction-wise, we're looking for a little bit more of this, a little bit more of that. It's an iterative process that really allows us to essentially be very focused. That's the trick here. We got 2 pipeline discussions a week, one on Monday, one on Friday. We know what we want. Pipeline comes in, it's just like, nope, that's the one. And then you run.
So alongside of providing these solutions for LPs seeking liquidity, there's been a big and growing market of GP stakes and financing. How have you thought about partnering with GPs?
It's interesting because in around 2019, we were doing all of these things with LPs and we're like, well, actually, we could probably do this with GPs as well. Sit somewhere between the debt and the equity and provide structured equities for GPs, for management companies. And essentially sitting between the debt and the equity in GP stakes and allowing GPs to be thoughtful about their management company and how they're managing it. What I found interesting is that for the longest time, GPs were private equity partnerships, and they were spending so much time on their underlying companies and how to add value to the underlying companies. And then just recently they woke up and they're like, whoa, wait a second, we're an asset management firm. And we should be thoughtful in terms of how we're managing our management company. So what you're going to see over the next decade, we believe, is this trend towards GPs being a lot more thoughtful in terms of how they're managing their management companies and thinking about new products, thinking about new geographies, thinking about balance sheets, thinking about succession, thinking about all of these things, which is going to, I think, create an opportunity with regards to the GP stakes market. We're here to add another tool in the tool set for GPs as they think about their management company and how they want to manage that, to give them another tool for liquidity.
Where do you think all this goes from here?
I mean, I'm on the record for saying that the secondary market's going to get to $1 trillion by 2031. Whenever I say that, the first reaction is, you're crazy. And I've heard that a few times, I guess, in my career. But I have a deep conviction around this prediction. And I think you need to be able to break it down into 2 parts. How's the volume going to get there? And how's the capitalization of the industry going to get there? Let's talk about the volume. For me, the volume is very simple. It comes down to 3 things. How big private capital is going to get over the next 5 to 10 years? What's the churn rate? And as sub-asset classes like real estate, private credit matures, how much are they going to add to this market? Let's go through each one. Private capital. It grew from $5 trillion to $15 trillion from 2016 to 2023. That's a tripling. Can it double by 2030? Think about private wealth. Think about how much capital is coming from private wealth. I would say that's a conservative assumption. So if you believe that private capital can grow to 30 trillion by 2030, the 1% that we're seeing right now in churn rate in private capital needs to grow to just over 3% in order for the secondary market to get to $1 trillion a year. And so I think that from our perspective, like, how do you get that churn rate up? You think about private credit secondaries, you think about real estate, you think about infrastructure, which are still in the early stages of ramping up in terms of AUM. And as those portfolios get more mature, investors are going to need more liquidity. But it's not just that. In private equity itself, LPs are going to become more sophisticated in how they manage their private equity portfolio. Going back to this theory around like, hey, if you haven't done anything for 10 years in public markets, is that fiduciarily responsible? It's going to be the same question. In 10 years, if you have not done a secondary, people will be looking at you saying, is that the right thing to do? Once somebody, an LP, gets used to selling, it goes back to the market repeatedly because the first time's the hardest. So watch this space. The maturation of private credit, real estate infrastructure, the churn rates going up, and private capital going to 30 trillion by 2030. That should get to $1 trillion. Time will tell.
You've been at this for a decade. What do you think is the bottleneck in why the secondary market is, say, only 1% of private equity volume today?
So it's been capitalization and it's been resources. Let's go through the history of the secondary market. 2001 to 2011, the decade of institutionalization. It went from 5 billion to 25 billion during that decade. Most of it was just LP secondaries. That was it. 2011 to 2021, it went from 25 billion to 125 billion, 132 to be exact. Another 5 times growth. But during that decade, it was the decade of innovation. We went from just having LP secondaries to having private credit secondaries, real estate secondaries, infrastructure secondaries. You had single asset continuation fund, multi-asset continuation fund. You had preferred equity. You have NAV lending, all in one decade. So we got to 125 billion, but what that has done is left the secondary market long opportunity and short capital. There is not enough capital to absorb the pent-up liquidity in this market. So we see 21 to 31 as a decade of capitalization. Generally speaking, what happens is that capital lags opportunity. If you're out in the market right now, there's really 2 areas where LPs are looking to allocate: private credit and secondaries. It's the talk of the town. So you know that just institutional market, it was 70 billion raised in 2021. Can it grow 7 times to 490 by 2030? It did. That gets you to 500 billion. The second part of this is private wealth. There's $150 trillion in private wealth of assets under management. 2% of that gets allocated to private equity or private capital. That's $3 trillion. It should be 10 to 20% if it follows institutional capital models. That's $15 to $30 trillion of money flowing from private wealth into private capital over how long? Let's take the more conservative number. 10% of 150 trillion is 15 trillion. 3 of that is allocated to private capital. That's 12 trillion coming in the next, 5 to 10 years? What if secondaries would take a quarter of that? You got 3 trillion coming in to secondaries through private wealth. So I think that's the combination of volume and capitalization that gets us to that $1 trillion figure, and time will tell.
Where do technology tools come into play to be able to help manage the scale in what historically has just been a deal-by-deal business?
It's really interesting. We are a tech-enabled asset management firm, and it's something that we focused on since our early days. Was we knew technology essentially was going to make a difference. And I remember sitting down with one of my mentors back in the day, and I said, what have you done differently if you would do it again? He's like, technology. If you don't get technology right, you're going to have 25 software systems that won't talk to each other. So we spent a lot of time in our early days really trying to figure out our tech stack. And today, wow, technology has enabled us. AI has enabled us. Machine learning has enabled us. Scraping data, turning that data into information, into insight. That data, if transformed into insight, can be incredibly powerful. So there is a shift going on in this market right now. The people that are leaning into technology are going to be able to differentiate themselves. The people that are lagging are going to be left behind in a hurry.
What are some of the ways that you've used these modern, say, AI tools and machine learning tools to improve your process?
We talk about proactively pricing funds. We're using that AI to scrape data and coming out of PDFs into our models. And that allows us to avoid, or at the place of using our resources for manual input, you're using it for actual analysis because the data is already in. It also allows for greater accuracy of data because actually those machine learnings are incredibly powerful. The accuracy that we're seeing out of our system, and we're just seeing the benefits of that right now. The white papers that we're putting out as an example, these are all because of the data that's available to us that we can transform into insight. And that's good for the white papers that we put out, but imagine what that can do for our investment process when you've got that much data and you know how to mine it. So data is useless if it's not accurate, and data is useless if you don't mine it. So you have to really build a technology platform that enables you to do both. And we feel really good about where we're at right now.
What are some of the financial innovations that you're looking at that you think the market might now be ready for, but might not have 5 or 10 years ago?
Oh, that's the secret sauce, though. Am I allowed to say that? I don't think I want to do the secret sauce. That's looking into the future, where the success is going to be. I do think the secondary market has gone through a big period of innovation. And anytime you go through a period of innovation, you essentially expand the market. The market needs to catch up on capitalization before it can get to the next version of innovation, I would say. The secondary market is setting itself up for the next big wave of growth through all of the innovation that's happened over the last 10 years.
As you look at all the transactional data you've collected over the years and you're looking at a new deal, I'm curious, what you found the biggest drivers of success for private equity firms in the business.
I really think it's culture. The culture of these firms are so important in terms of, are people motivated? Are they rowing in the same direction? Are they well aligned? Are they in a good place? Are they stronger together or are they growing apart? So I think that's one of the big things in terms of continued success is aligning your people with the success of the organization and making sure that the culture is one that is set up for success. And then it's hard. And the reason I paused is because I don't think there's one model in private equity. I think there is so many different models that can get you to success. And it's different strokes for different folks, and that's okay. The culture of one firm can be very different than the culture in a different firm, but have they attracted the right people that thrive in that culture?
Well, Yann, before I let you go, I want to make sure I ask you a couple of closing questions. What is your favorite hobby or activity outside of work and family?
Canoeing the Arctic.
What is one fact that most people don't know about you?
I'm an introvert. I may be a social introvert, but I'm an introvert. I need time on my own to recharge.
How has that played out in leading a business like this?
Just got to be self-aware of where you are. I have a cottage that's 2 hours north of Toronto. I spend a lot of time up there in nature at the cottage, and I know when I need it.
How do you communicate that to the people around you?
They've gotten to know. They'll just tap me on the shoulder and say, why don't you go to the cottage for a couple of days?
What's your biggest pet peeve?
I would say problem finders versus problem solvers. If you just think outside the box, you can solve anything. Self-limiting beliefs, limited thinking.
Which two people have had the biggest impact on your professional life?
So I would go with David Dennison, who's the ex-CEO of CPPIB. I talk to him probably every couple of weeks, and he's been just so good to me in terms of just, he's not a man of many words, and hopefully he's okay with me saying this, but he has just got an incredible North Star, and these are your blind spots. This is what you need to be careful about. My mother, for her good and her challenges, she's been such an incredible supporter, and she's given me the conviction to go out there and grow my wings. So I appreciate her.
What's the best advice you've ever received?
You can be a good person and win. I just really believe that. I have to look at myself in the mirror every day and just be proud of not just what, but how. And I really believe you can do it. If it doesn't feel right, don't do it. Think about the long term. And again, I'm not perfect. I will make mistakes, but my intentions are good, or so I believe. So just do the right thing, which is actually what's been interesting about the secondary market, is that the leaders in the space have, generally speaking, been very good people. There is a camaraderie around the secondary market, which I think is unique. And again, has the market done everything right all the time? No, it's learned along the way. It's made its mistakes. But generally speaking, you've got good people in this industry trying to figure out the right way to do things.
All right, Yann, last one. What life lesson have you learned that you wish you knew a lot earlier in life?
I would say find inner stillness as quickly as possible. Unpack your shit. Find calm in the chaos. Make sure that your drive comes from a healthy place, not an unhealthy place. Be very aware of what is driving you. And there's no destination on this journey. So you got to enjoy the ride.
How did that come to you in your path?
I would say I was pretty insecure in my 20s. I was getting comfortable in my skin in my 30s. My 40s have been my best decade. I've embraced who I am. And I probably about 7-8 years ago, I just started getting curious, looking inside. The outside world, you can have check everything, but if you haven't dealt with your shit, it doesn't matter. So what's driving you? We all have fears. We all have patterns. So just be curious and try and unpack the fears that you inherited mostly from your parents, not because they didn't love you, but it's generational.
What are the ones that you discovered that you feel like you've best improved upon?
Probably the fear of not being good enough. I definitely was driven by fears. And that's why you said what you should wish you would have done earlier in life. I don't regret anything, and I'm really proud. 14-year-old Yann would look at 48-year-old Yann and be like, good for you, bud. From where I started to where I'm at today, I'm not arrogance, but just proud. But it took me some time to get to a point where I was like, oh, here are some patterns, here are some behaviors. How can I do better? How can I improve myself? How can I grow?
Well, Yann, thanks so much for sharing this innovative perspective on the secondaries market.
Thank you, buddy. It's been fun. Appreciate you.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.